Hey, how's it going, everyone? Today, let's go ahead and talk about Skyworks Solutions, ticker symbol SWKS. This is a technology company that makes semiconductor chips for all things related to Wi Fi, 4G, and 5G radio frequency waves. They are currently down year to date by negative 10%. They pay out a 2.8% dividend yield. Their trading multiple is 20.20, which is the PE ratio. So in this video, I'm trying to figure out, is this company undervalued or not? Why are they going through such a massive sell-off? When we look at their one-year performance, they're up by 1.3%. Amazing. Oh my goodness, a 1% return. But jokes aside, we're going to go ahead and look at Skyworks intangibles, their finances, and run some valuation models to figure out if it's a delicious or a disgusting dividend stock that we should all stay away from. Now, this is a YouTube channel that loves dividends. So the first thing that we're going to be taking a look at is their dividend profile. So as mentioned earlier, the dividend yield is 2.8%, which is about average. It's modest, which means for every share of Skyworks that you own that trades for about $97 a share, you get $2.80 a year in dividends. The payout ratio is really sustainable at 39%. Actually, that's really healthy, and it looks fantastic from a dividend perspective. The 5-year growth rate is 12.5%, meaning this company has been growing this dividend payout at a rate of 12% year over year, and they've been growing it for 8 years straight. And when we examine their dividend payout in a 10-year lens, back in 2014, for every share of Skyworks that you had, every 3 months or each quarter, you would have been paid 11 cents a share. And as we fast forward throughout the years, this is exactly what you want to see in a dividend compounder. That dividend payout increasing every year, but also the payout ratio staying low or relatively modest. And as of August, now you get paid 70 cents a quarter. And as we scroll down right here, you can see the numbers. 2024 looks like they did increase the dividend once again from 68 cents to 70 cents. And as we saw earlier with 2014, 11 cents, they bumped it up to 13 cents, which is kind of interesting because they actually paused the dividend payout for a long time. From 1985 to 2014, they did not pay a dividend. I think it's because the company was probably going through their growth phase. But now that they have matured a little bit, they're like, hey, we can actually afford to pay a dividend, just like Google did, Meta did. It's usually what happens when a company becomes mature. The next thing that I want to take a look at is their total return to see if this company is even worth investigating. Now, when we look at the 5-year performance for their adjusted stock price, it's up by 35%, which is not the greatest thing in the world, but it's not terrible either. However, that's not a complete picture, because if we zoom back in and look at it from 3 years, well, it's down by negative 38%. What's going on here, right? So if we zoom back out to 10 years, then you would have been up by 104%, which is good. I like that. And if we zoom out by 20 years, okay, now we're talking. You would have been up by 1,100%. So it does look like this company is worth looking into for the time being. But in the short term, it does look like they are going through a massive sell-off. Being down by negative 38% is not a joke. Like, that is pretty heavy money right there. That's not good. And we're going to be investigating that here in a second. Next up, we are going to be looking at their shares outstanding. Essentially, we want to answer the question, are they issuing more shares and diluting the shareholders, or are they buying back the shares? And when we zoom out to all history, let's look at this. Back in 2010, they had about 183 million shares outstanding. And it looks like this was right after the Great Recession. So they were issuing more shares. And then it kind of flattened out right here. And then in, 2016 is when they made the decision to start buying back the shares and decreasing the amount of shares outstanding. And as we fast forward, man, this is a beautiful thing to see. So that bottom graph that you see that says like what, negative 3.6%, that means they bought back 3.6% of the shares that were outstanding, which is what you want to see. And as of last year, it looks like they did start to slowly issue more shares. But all that to say, there's now currently 161 million shares outstanding, whereas back in 2010, there were 183 million shares outstanding. And then at their height, there was 195 shares outstanding. And when we scroll down right here and look at the numbers view, it's not terrible at all. This is exactly what you want to see. The only concerning call out is that they are starting to issue more shares, but it's not anything crazy. It's 0.6%. If they were issuing like 5%, 9%, or even 10%, then the red flag would go up. But all in all, I think their shares outstanding looks like a good picture so far. Next up, we are going to be looking at their revenue. And what we want to see is a company that is growing their top line, whether it's organically or inorganically from acquisitions, year over year, or at least to be consistent, right? It's okay if a company has like a flat period of like 2 to 3 years if they're going through some headwinds. But if they're just consistently flat or even declining year after year, then that's a company that does not have a bright future, in my personal opinion. So when we look at their revenue, back in 2009, they posted $837 million for the trailing 12 months. And as we fast forward, yes, this is exactly what you want to see. Back in 2018, they posted $3.8 billion for the past 12 months. And then as we zoom right here in 2022, that's the most the company has ever made, which was $5.4 billion. And since then, as you can see, the cyclical nature of semiconductor chips, they are now declining once again. And as of recently, they posted $4.3 billion of revenue in the trailing 12 months, which I think is still pretty good, but it's a decline of 15% from the year prior when we look at it from the quarterly breakdown. And when we scroll down right here and we look at the numbers from their fiscal year calendar, 2011, $1.4 billion. And as we fast forward, it is consistently going up, but it does seem like they topped out in 2022 and they are on the decline once again. So this is something that you do want to be mindful of, which is why for the longest time until that AI movement started, semiconductor chips go through cycles, right? Sometimes they're hot, and sometimes they're not. And it has been an industry that is pretty volatile for the past few decades. So what you are seeing right now in NVIDIA and Broadcom and some of these other semiconductor chips, it's not normal. But it is the norm for the time being, with AI being the new gold rush. Next up, we are going to be looking at their free cash flow. Essentially, is this company turning a profit and generating cash? So let's see. Back in 2009, they posted $179 million of free cash flow. And sometimes they do go down, but they do recover. And the best thing that you want to see is a company that is consistently growing their free cash flow in the right direction, in the right trend. And for Skyworks, this does seem to be the case. As of last year, they posted $1.6 billion of free cash flow. Ladies and gentlemen, this is a beautiful cash-heavy company from what we see on the surface level. Next, let's go ahead and talk about their business model. How do they make revenue, and if they have an economic moat? And what you see on your screen right now is their latest earnings report. So you can go ahead and read that if you want, or you can just listen to what I'm about to say. So the best way that I can describe Skyworks is to think of them as the little cousin to Qualcomm and Broadcom. Skyworks is a part of the RF, radio frequency chip sector. The good news is most phones that are being made right now, they have 5G technology, which means that Skyworks RF chips will be in these phones. And newer technology means more complex signals that can be sold for higher prices with higher margins. But these chips don't just go into phones and tablets, but Skyworks also supplies RF chips into niche segments such as electrical meters when you park your car, medical equipment, and keyless entry for a car so that you can connect with it through your mobile app. But what exactly is radio frequency? Maybe we need to take a step back. Radio frequency, aka RF, are communication waves that carry information from point A to point B, such as a Wi-Fi router supplying internet signals to your phone. Or in another example, when you talk on your phone, your voice is actually turned into an RF wave by your phone's antenna. And then this wave travels through the air to a nearby cell tower, which then sends it to the person that you are talking to, whether they are in Canada or Germany. The whole process happens so fast that you don't even see it. These waves are invisible. RF, radio frequency waves, are the pillar of communication. And something that you might not know about Skyworks is that they have an exclusive partnership with Apple to supply their phones with the latest 5G chips. So their success is predicated upon Apple selling a good volume of iPhones every single fall once they release the newest model that literally comes with the exact same features and appearance and logo looks as the last year's model. But that's neither here or there, because to sell a phone with 60 hertz display in 2024 for about $800, that's an atrocity. 66% of Skyworks revenue in fiscal year 2023 was attributed to Apple. So I think right now there's some hesitation around Skyworks because the sales growth of the iPhone is starting to slow down. And they lost a major contract to Qualcomm not too long ago, which made all of Wall Street really bearish on this company. And that explains the sell-off and why this company is in the red right now for the past, 9 to 10 months. But not only that, too much of their revenue is tied up in the sales of mobile devices. And right now, the average consumer around the world is having a financially difficult time. As you can see right now on your screen, they also supply the RF 5G chips to the Google Pixel 8 Alpha, the Samsung Galaxy M series, the Oppo Reno 12, and a few other phone companies. So it's not just Apple that people are concerned with. This is a worry because more and more consumers, if you think about it, they're hanging on to their phones for an extra year instead of upgrading every cycle. I remember when I was going through college back in 2010, it was normal for someone to upgrade their phone every single year because the technology was rapidly evolving and you wanted to have the latest and greatest camera or touchscreen or what have you. But these days, phones are making small changes from the year prior. So more people are just hanging on to it, which means if less phones are being manufactured, then less of Skyworks chips will be purchased as a part of their procurement team. It's basic supply and demand. But on the flip side, despite what I just said, you still have to keep in mind that a lot of people around the world still buy an iPhone every single year, which means the demand for Skyworks chips with 5G technology is still pretty high. And that's the reality of things as it stands right now. Despite the sale of iPhones slowing down, people are still buying iPhones. So if you don't get it by now, Skyworks win if Apple wins. It's also worth mentioning that Skyworks is diversifying into making chips for vehicles, which do show promising signs. But just like a phone, it's not every day that you buy a new car. Cars are not a consistent source of revenue. So one year, Skyworks could do really hot. And then the next, they could have a dip in demand. Regardless, at least this company is smart enough not to put all of their nipples into one brawl. Skyworks is diversifying, as you can see on your screen right now. With the launch of the Wi-Fi 7 tri-band routers, they are supplying it into the big name brands such as Netgear. And they called out that they accelerated their design for their automotive pipeline, which, I think is a win for them. And when I think about Skyworks, I wouldn't say that they necessarily have an economic moat because there's quite a few players in the RF field. However, Skyworks do have a competitive advantage in that they have decades worth of experience in manufacturing, designing, and partnering with the major players in the industry that need their products. I'm going to tell you right now, it's not every day that a startup company will become an RF business that supplies their chips to the biggest consumer brands of the world. It takes time and consistency to build a partnership with big household names. And although Apple, Samsung, and Google produce their own CPU chips, those chips are reliant on silicone-based chips. That's the industry standard. But when it comes to RF chips for communications, it's based on gallium arsenide. So I'm certain that Skyworks has a lot of intellectual property on manufacturing their specialized RF chips with that unique material instead of silicone. All that to say, even if Apple wanted to make their own RF chips in-house to get rid of Skyworks, it would be difficult to do it as good as Skyworks can because they only know how to do it with silicone technology. And as you can see on your screen right now, Skyworks, just like Qualcomm and Broadcom, they have a ton of intellectual property with over 4,900 patents. This is how they make their money. They create this technology and then establish a patent around it so that they can be the ones that collect that toll booth money. The downside to that is technology is always evolving, which means a patent that was incredible in 2018 is probably fossilized and no longer relevant 4 years later. So they have to be continuously evolving, innovating, and researching to develop the best and new RF chips. Besides, if you're Apple, are you really going to gamble on outsourcing the RF chips to a new startup that can give you a better price or to another company that might run into quality control issues just so that you can save a few $1,000s on your procurement contract? No, you're not. If you are the vice president in charge of the iPhone supply chain, why would you ever want to take that risk? I'll tell you right now, as a former director in corporate America, most executives in business operate with the mindset of why fix it if it ain't broke? Meaning the path to safe and consistent results is better than the road less traveled, because it's better to play it safe than to be sorry. All to just save a few pennies on each chip, it's not worth it for your career. So executives are just going to stay with the tried and true, which is Skyworks. So I think the Skyworks Solutions partnership with Apple is relatively safe for the time being when it comes to RF technology. And before you think their RF life cycle ends with 5G, that's not true. Because when 6G rolls out, and it will, because back in 3G times, people were like, there's no way 4G is ever going to happen. And then 4G happened, and then 5G happened. But when 6G eventually comes out, Skyworks should be the leader in making RF chips for those products as well. iPhone 22 or iPhone 23, yeah, you can bet it's going to have a 6G chip in it. And if you listen to their earnings calls or interviews with their CEO on YouTube, you're going to see quite clearly that they make it an emphasis that Skyworks is a technology company that makes 5G possible in the Internet of Things era. And they don't want to be known as just a chips company, which is kind of funny because they give themselves credit with how people are able to play mobile games while out in public, with how Twitch live streamers are able to walk around and connect with thousands of people around the world, tuning in real time and allowing uninterrupted communication that happen in life's most important calls. They literally say those phrases. And to that, I get their point. But their business is based on being behind the scenes. No one is going to see them as a tech company except for themselves. They're kind of delusional. Apple calling themselves a tech company, it makes a lot of sense. Microsoft, yes, that makes a lot of sense because both of them provide a product, infrastructure, apps, and everything you need in an ecosystem with the brand Apple or Microsoft screaming in your face. It provides that face-to-face customer value. But when it comes to Skyworks, you just get the RF chips as part of the hardware, and the average consumer, unless you gut a phone or a tablet, they're going to have no idea who Skyworks is. So despite Skyworks identifying as a tech company, I still view them as a chips manufacturer that has a ton of patents. But hey, remember, their finances look fantastic, so let's give them some credit, even if they're a little delusional. And based on this market research and the CAGR, the compound annual growth rate for radio frequency going forward, for the United States, it's forecasted at about 12.9% year over year for the next 9 years or so. And when we scroll down right here, China, the growth rate should be at 15.1%, Japan 13.5%, double digits all across the world, which means the radio frequency industry, it does have a bullish case going forward. However, what I do want to point out is that, let's see, Skyworks, what you see on the bottom of your screen, are not the only players. As I alluded to earlier, there's a ton of companies in the RF space that are competing for these contracts with big companies. But regardless, to have the industry CAGR, hover around 13% year over year for the next 9 years tells me that this industry is pretty good. Because when you think about the future, more and more people are going to have a tablet in their hand, a mobile phone in their hand. They're going to want more technology in their cars, right? So I think the need for 5G and 6G chips in these products are going to grow. And I was wrong. It's 14% actually, the CAGR across the world. the compound annual growth rate. Which means if Skyworks is able to secure maybe like 10% of that 14%, their future does look a little bright. And now we made it to my most favorite part of the video, which is running some valuation models to figure out the intrinsic value for Skyworks. Because hey, the intangibles are really cool to look at, to speculate their future and their prospects, but the numbers and the data, they don't lie, right? So right now we're about to review their finances and their numbers to figure out how much is this company actually worth, their stock price. The first one is going to be the multiples valuation. The industry peers and how the market values them is going to give us a price for Skyworks. And when we look at the other semiconductor chips doing the same thing they are doing for the most part, the median PE ratio is 21.9. And as of right now, at the time of filming this video, their PE ratio is sitting at 20.2, and they're trading for $97 a share. So with a median PE ratio of 21.9, this gives us a stock price of $106.04 a share. So according to the multiples valuation, Skyworks is a little undervalued. The next one is going to be the discounted cash flow analysis model. Basically, their free cash flow is going to tell us how much this company is worth going forward. For the past handful of years, their free cash flow has been a little shaky, meaning sometimes it goes up by double digits and other times it goes down by double digits. It's not a perfect trend. However, it is going in the right direction because when we look at 2018, Skyworks posted $838 million. And as of last year, they posted double that at $1.6 billion. So it's going in the right direction, but sometimes it goes up and sometimes it goes down, which means based on the numbers, their average growth rate, their free cash flow, it's been going up by 19.4% year over year. However, this is going to be controversial. I don't know if their future is going to be too bright for this year and the next. So with that said, I want to be conservative. I want to play it safe. So I'm going to plug in 4% instead, meaning their free cash flow is going to grow at a rate of 4% year over year. And when we look at their balance sheet, it's actually not too bad. They have about $1.2 billion of cash and cash equivalents on hand. To that, they have $1.2 billion of total debt, meaning they could use all of their short-term reserves and capital to pay off all of their debt right now. And they only have 160 million shares outstanding, which is not too bad. So taking all of these variables into consideration, the DCF price is going to give us $196.53 a share. Had I plugged in something closer to 15% or even 19%, yeah, their DCF price would have been a lot higher. The next one is going to be the DDM, the dividend discount model. Their dividend payout and the growth thereof is going to tell us how much Skyworks is worth. And objectively, they've been growing their dividend at a rate of 11.5% for the past handful of years. However, as you know on this channel, I prefer to use conservative numbers. That way, I don't optimistically overestimate how much a company is worth. So instead, I'm going to say, hey, this company is going to be able to grow their dividend at a rate of 6% year over year going forward. So with that in mind, their DDM price is going to be $144 a share, which screams that Skyworks is undervalued. And the last one is going to be the Benny Graham's valuation model. And that's going to be $112 a share. So my thing is, Benny Graham's almost always spits out the lowest intrinsic valuation for a company whenever I do a review. And if they say that a company is undervalued, then the company must be undervalued, right? Off a surface level. But anyways, that brings us to the conclusion. What is the intrinsic value for Skyworks Solutions? Jimmy, you gotta hit him with a drum roll. The intrinsic valuation for Skyworks is going to be $139 a share. What do the Wall Street analysts believe that Skyworks should be valued at? Well, they say $115 a share. So we're a little more optimistic, even though we used very conservative and lowballing numbers. We said that Skyworks is worth $139. That means Wall Street probably used really bearish numbers to reach this conclusion. But anyways, after looking at everything, I want to know, what's an acceptable buy price for Skyworks? Because I don't want to pay too much for this company. So right now, we're going to go ahead and say that the company is trading for $97 a share. With a 10% margin of safety baked in, then my acceptable buy price is $125 a share. Meaning if I buy it at $125, I can almost be guaranteed to get a safe 10% return at that price point. But as you can see, the company as of right now is trading at a $28 discount to this acceptable buy price. So if we were to say something like, I don't know, 20%, at a 20% margin of safety, then my acceptable buy price is $111 a share. And if I were to buy into Skyworks right now at their current trading price, then I would get a 30% margin of safety. But you know what? Let's go ahead and do something different. I'm going to plug in the Wall Street valuation of $115 a share instead of our intrinsic valuation of $139. Let's go back to a 10% margin of safety and plug in 115 right here. With a 10% margin of safety baked into what the Wall Street analysts believe Skyworks to be valued at, then the acceptable buy price is $103 a share, which means it's still undervalued. No matter how we spin it or say it or with what accent, it's still undervalued. All right, so after looking at everything, the numbers, and running these valuation models, what are my thoughts and opinions on this company? This might be an unpopular opinion, but I think the company is fairly valued at about $97 to $99 a share right now. And in comparison to other semiconductor peers, yes, they are undervalued. But the thing is, the market does not really like Skyworks. Skyworks is not popular like Qualcomm, Broadcom, AMD, or even Nvidia. Their stock price is reflective of that statement. That's where Wall Street is bullish on. Skyworks, in my opinion, has a decent future ahead of them, and they are a great company. They have good margins, good balance sheet, good finances, good patents, good products, but that does not necessarily mean that their stock price will share the same fate. It's a sad reality that some stock market companies face. Like, that's their DNA, their biography. And for that reason, I just don't think that right now I'm going to be investing into Skyworks. Unless, of course, it hits a ridiculous 52-week low price. If it's at a huge bargain, then I might change my mind. Because my logic is, even if the company is undervalued and is a dividend compounder with cheese, as we saw earlier, the 20-year return is 1,100%, it doesn't matter. Because for the past handful of years, we can see what is happening. This company is in the red because big investors in Wall Street, they don't see value in Skyworks as of recently. And so for me, it's not worth the investment. What I'm trying to say is, if I buy into Skyworks and my position trades flat or even goes into the red over a span of 3 to 5 years, that's not going to feel good. And I say that because I learned my lesson with 3M. I actually bought into 3M's dip a few years ago when I knew that they were undervalued, and Wall Street did not agree with me, right? Because they were going through a lot of litigation risks. They were going through a divestiture, and their future was kind of uncertain. So I get it. And it took about 500 days for me to break even in my 3M investment. And then from that point, another like 100 or 200 days to be in the green. And now, fortunately, I am up by double digits, but it took years to get to that point. So I would rather be in the green from the get-go because I think of opportunity cost and the psychological effect of having something in my portfolio being in the red. It's not a good feeling, right? Like, if you buy into a company and it goes down by 5% and then year to date, year later, it's down by negative 20%, it takes a toll. It's a mental effect, and I don't like it. I would rather pick a winner that Wall Street and the stock market agrees with me on, and so it's up in the green, 3 months out, 3 years out, 30 years out. I don't like the whole idea of having to wait for a company to bounce back, if you get what I'm trying to say. As such, I just feel that putting my money into Skyworks might not be the best placement as of right now, because I only have limited capital. And Skyworks is just not it. But with that said, if all of my watch list companies reach their 52-week highs and everything is expensive and Skyworks just happens to bounce around $86 to $88 a share, then I might give them a chance. Because from my understanding of the industry, I'm pretty bullish on 5G technology and the upcoming 6G movement, which is why I invested into CCI, which is a cell tower REIT. But it's unfortunate that Wall Street does not share that sentiment when it comes to Skyworks. They don't like it. So that's what I think. But remember, I could be wrong. I'm just a cheeseburger that knows how to do math. So please do your own due diligence and research to reach your own conclusion because I could be wrong. I'm serious. Maybe Skyworks is the next NVIDIA and I'm just missing out, right? But bottom line and summary is that this company is undervalued, but their future, especially for the short term, it does not look too bright in terms of the stock market return. But the company itself and their business model and their product, yeah, they're going to be okay. They're going to do great. But anyways, I hope you have a good day and I'll talk to you next time. Stay safe. See ya.